Good morning and welcome to T-Hub Capital, the Investors Lounge, the podcast where we explore financial market dynamics, emerging trends, and the insights that shape successful investments. Each week, we'll delve into the strategies and analyses that drive our investment decisions. You'll get an insider's perspective on the factors influencing markets and the potential winners and losers of tomorrow. Subscribe to the podcast to stay ahead of the curve and make informed investment choices. Enjoy listening.
Welcome to T-Hub Capital's The Investors Lounge weekly podcast. Today's date is the 16th of March. Let's dive into the week's top market news. Europe amid geopolitical tensions and manufacturing slowdown. An analysis of Q1 2026. The European equity landscape opened the year under the sign of uncertainty, reflected in a weekly contraction of 0.47% for the Pan-European Stocks Europe 600 index. Investor sentiment remains heavily weighed down by the duration of the conflict in the Middle East and the resulting volatility in energy prices, factors that cast a shadow over regional economic growth. The performance of major national indices highlights a marked fragmentation, with the French CAC 40 retreating sharply by 1.03% and the German DAX falling by 0.61%, while the Italian FTSE MIB moved against the trend, posting an increase of 0.37%. The UK's FTSE 100 also suffered a slight decline of 0.23%, confirming a climate of general caution. The institutional response was swift, delivered through the words of Christine Lagarde. The president of the European Central Bank reaffirmed the Frankfurt institution's firm intention to take necessary steps to contain inflationary pressures stemming from the energy shock. Although Lagarde maintains that the European economy currently possesses greater resilience than during previous crises, she acknowledged that price stability remains vulnerable to an external environment characterized by high unpredictability. The continent's industrial engine, represented by Germany, is showing clear signs of strain. In January 2026, German factory orders suffered a month-on-month collapse of 11.1%, a figure significantly worse than the 4% decline estimated by consensus. This weakness was primarily fueled by domestic demand, which fell by 16.2%. though exports also recorded a 2.3% decrease. Simultaneously, industrial production for the entire Eurozone slipped by 1.5% in the same period, marking the worst monthly result since April 2025 and contradicting analysts' forecasts of a 0.6% increase. Across the Channel, the scenario appears no brighter. The UK economy recorded flat growth in the first month of the year, disappointing expectations of a 0.2% increase. The Office for National Statistics highlighted that stagnation in the services sector, where progress in retail trade was offset by declines in administrative activities, is hampering the recovery of British GDP following the modest 0.1% gain recorded in December. Now our insight into alternative markets. The 7 trends shaping investment and M&A strategies in the near future. The current macroeconomic landscape confronts us with a drastic paradigm shift. After over a decade dominated by zero interest rates and abundant liquidity, we are navigating an environment characterized by restrictive refinancing rates and inflation that, although normalizing, requires careful calibration of monetary policies. This structural shift directly impacts the cost of capital, WACC, and the discount rates used in our valuation models, discounted cash flow, making the market far less tolerant of inefficient or overvalued companies. Today, outperformance no longer stems from broad market tailwinds, but from a return to rigorous fundamental analysis of financial statements, P&L, balance sheet, cash flow statement, and a careful evaluation of the risk/return profile. As an analyst at our investment firm, we have analyzed recent dynamics in the equity and bond markets, intersecting them with developments in corporate reporting and extraordinary financial transactions. Based on academic literature and consolidated historical data, we have identified 7 strategic trends that will characterize capital allocation and mergers and acquisitions, M&A, in the coming years. Below, we present our vision, structured to guide our future portfolio decisions. 1. Systematic integration of ESG criteria in creditworthiness and valuations. It is no longer just about compliance, but about bankability and risk assessment. The impact of environmental, social, and governance (ESG) factors is becoming a central parameter for private equity funds and the banking system, especially for SMEs. 2. Semantic analysis and alternative data for short-term valuation technology is transforming how markets price information. We are witnessing the emergence of semantic recognition software capable of real-time analysis of CEO speeches, press releases, and even the grammar of financial messages on social media. This approach allows us to anticipate market reactions and leverage new sentiment indicators to beat benchmarks. 3. The tension between short-termism and long-term value creation. Investors are increasingly divided between short-term horizons, focused on quarterly guidance and EPS, and the pursuit of long-term fair value. Companies that manage to resist short-term pressures to focus on adjusted present value, APV, and real discounted cash flows, DCF, will offer more stable equity risk premiums over time. 4. M&A driven by real operating synergies, not just consolidation in M&A transactions. The calculation of the acquisition premium will be increasingly tied to the demonstration of tangible synergies. Valuations, via DCF and enterprise value approaches, will penalize management teams that overpay for control without a clear integration plan. The adjustment of market expectations, noise, around M&A announcements will become faster. 5. Strict scrutiny of share buyback programs. The market is learning to distinguish between real value creation and pure financial engineering. Share buybacks, often used to reduce balance sheet liquidity and artificially boost earnings per share, EPS, will be viewed with greater suspicion if executed at high market valuations, as they risk fueling financial bubbles without increasing the intrinsic value of the company. 6. Working capital optimization as a strategic lever in a macroeconomic environment characterized by fluctuating interest rates. Internal efficiency is crucial. Ratio analysis will increasingly focus on working capital management as a primary indicator of earnings quality and self-financing capacity, which are essential for preventing corporate distress. 7. Tightening of the regulatory framework for financial disclosure. The regulatory framework for financial disclosure has significantly tightened. Companies with a transparent and consistent communication style will benefit from lower share price volatility, reducing the standard deviation of analyst estimates, reduction of noise. Operationally, our asset allocation and M&A strategy will translate these macro trends by overweighting companies capable of generating resilient free cash flow, FCF, while simultaneously underweighting firms characterized by excessive financial engineering or high EV/EBITDA multiples unsupported by productive investments, all while rigorously integrating ESG metrics into risk valuation models and maintaining constant monitoring of macroeconomic dynamics.
Thank you for listening to this episode of T-Hub Capital, the Investors Lounge podcast. I hope you found this content interesting and inspiring. If you enjoyed this episode, don't forget to subscribe to the podcast so you don't miss a single episode and share it with your friends and colleagues who might be interested. To learn more about T-Hub Capital and our activities, visit our website, thubcapital.com. You can also follow us on our LinkedIn page. See you soon. All the best from the T-Hub Capital team.